Welcome. We're going to talk about the accounting cycle, and I've broken it out into two parts so that these videos wouldn't be that long. So let's get started. When we're talking about the accounting cycle, many times that's the bookkeeping cycle, or this is the way accounting's been done for the last 500 years. The first thing you do is, in business, you recognize that there has been a transaction, and you write that down in what's called the journal. It's kind of like Dear Diary. Today the following things happened to me at work. And when we journalize these transactions in the journal, or if you're doing it on a computer, the daily transaction listing, you do it in chronological order, and there's one debit and one credit. And a debit just means it's a left hand, and a credit just means a right hand, and debits always equal credits. There's no value to whether debits are good or credits are bad. It's just like a sentence has a noun and a verb. Same kind of thought, that's how you recognize a transaction. So once you've recognized that transaction, you take that transaction and you post it into the ledger. Now the ledger is a bunch of T accounts where you can sort all the transactions by type. So anything that impacted cash goes in the cash account. Anything that impacts accounts payable goes in the accounts payable account. And there's two sides to it, as you can see at the bottom down here, that on the left side is the debit and on the right side is the credit. So when you post that the journal entry, which is right up above, into the ledger, it contains the same information. It's just the journal is a chronological listing, and the ledger, or the T accounts, are sorted by type. Same information. To make sure you copied correctly, you prepare the trial balance, where you prove that you're a good copier and that debits still equal credits. And we'll do these first three steps in the second part of this video. Now at the end of the period, because you've been doing all these daily transactions, you really need to look over those transactions and say, has anything else happened this period that I have not yet journalized or recognized in transactions? And that's when we prepare adjusting journal entries, post them into the T accounts and the ledgers, and then prepare another adjusted trial balance. It's kind of like cleaning your room. You know, it's all in there, but you just need to put it in the drawers. So that's what adjusting entries do, and one of the videos after this will talk exclusively about adjusting journal entries. After that, you can prepare the ISHBS financial statements, and then you prepare closing entries. And what closing entries does is it says, okay, we've measured everything we needed to measure in this period, in this year. But now it's time to set the clock back to zero, so that when the sun rises and tomorrow is a brand new year, we can start that recognition and accumulation process all over again. Think about your tax return. You only want to include on your tax return what happened this year. And closing journal entries allow us to zero out those revenue and expense accounts and dividend accounts back and reset them back to zero, so that when the new year starts, you start recognizing them all over again for that new tax return next year. And after you've made your closing entries and posted them, of course you do a post-closing trial balance to prove that still you can copy. Debits equal credits. What I give you at the bottom here is the format of a good journal entry that you would make in the journal. Notice that the debits always go first and the credits go second. So for example, if I said, well, I went to the store and I bought breakfast this morning, so I would debit food expense and I would credit accounts payable because I used my credit card. So that would be an example of using account names, food expense, and accounts payable. Those are the account names for what I did. So just like I went to the store and bought breakfast this morning, that's it in English. I now translate it into accounting as a debit and a credit. If I then posted it to the T accounts, I would have an account for food expense, and I would have another T account for accounts payable. But let's just practice the debit credit rule. So that's what we're going to do next. All right, debit credit rules. We know that assets equal liabilities plus common stock plus retained earnings plus revenue minus expense. That's that expanded accounting equation. So what we're going to do now is make sense of it that the debit credit rules do fall with this. So let's see. I think we should talk about our favorite asset known as cash. So cash is an example of an asset. And let's say another favorite asset that I have is supplies. So if I have cash, cash and all assets are increased by debits and they're decreased by credits. So if I go to the store and I buy supplies for cash, that would be, well, what's going up? The asset supplies is increasing. Let's say it was for $10. And my credit is to cash because my cash is decreasing $10. So notice I can say it in English, buy supplies for cash, $10. Or I can say debit supplies, credit cash, $10. Either way, those debit and credit rules, debits increase assets like cash, credits decrease assets like cash, and it goes down. What if instead I buy supplies with my credit card? And that's called on account. Well, if I buy supplies on account, then yes, I'm going to debit supplies because my supplies, the asset, is going up $10, which makes sense, but I need a credit because remember, debits equal credits. And if it's an account, if I buy it on account, that's accounts payable. Well, accounts payable is increased by credits and decreased by debits. Well, let's see if that makes sense. If I buy supplies, my supplies are increasing, and also my bills or my liabilities, my promises to pay in the future, are also increasing $10. Well, now what if I pay my accounts payable bill? Well, if I pay my accounts payable bill, that means I'm going to debit accounts payable $10 because my liability is decreasing. And the only way I can pay my bills is with cash. And my cash, an asset, is decreasing. So these are examples of the debit and credit rules with assets and liabilities. Well, what if I start a brand new business and I issue stock to shareholders? And that means that, and remember, I'm doing this from the company's point of view. So I'm going to debit cash because those shareholders are going to give me, I'm going to write for cash, and it's going to be a big dollar. So I'm going to debit cash $1, and because my cash is increasing because I've received cash from my shareholders. And I'm going to credit common stock $1 because my stockholders' equity is also increasing. So here I have a debit that increases an asset and a credit that increases shareholders' equity. What decreases shareholders' equity is a debit. All right, so far so good? All right, I'm going to have to erase here for a second so that I have a little bit more room, and we'll do a couple more. All right, so let's look at selling something. You know, the reason we're in business is we like to sell something. So let's say that I want to sell what should I sell? Why don't we sell homework answers? So I sell homework service for cash. Well, if I sell homework service for cash, I'm going to be debiting cash because I'm going to get cash. Let's say it's $2. So my cash increases. That means I need a credit, and my credit is revenue because I am selling services or goods, and so my revenue is increased by credits and decreased by debits. Say my customer is unhappy with me and asks for a refund. Asks for refund. Wrong problem. Well, then I'm going to be crediting cash because my cash is going to decrease, the asset's going down, and I'm going to have to debit revenue return, which is a revenue account. So that's how I would do a refund. All right, well, let's look at expenses. Now, expenses means you've used or consumed something. So remember those supplies we bought? What if we used $3 of supplies, and if that's the case, I would be debiting supplies expense to show that the supplies have been used, and I would be crediting supplies because remember, assets have future or potential value, and if we use them up, then they're no longer an asset because they don't have future and potential value. That means expenses are increased by debits and decreased by credits. So if you can see this, notice that the outsides of this chart act alike and the insides act alike. So think of it as a sandwich. The pieces of bread are increased by debits, decreased by credits, whereas the filling to the sandwich is debits decrease and credits increase. Let's try one more. What if I sell homework on account? Well, if I sell homework on account, that means that I am selling, so I'm going to but I didn't get any money, which means it's an account receivable. So I'm going to debit accounts receivable, and and I'm going to credit a revenue account, and I need amount, let's say $5. So debit accounts receivable $5, credit revenue $5. So notice once again, debits increase the assets and credits increase the revenue. And if I did my accounting equation and did the math of my accounting equation would stay in balance. That assets still equal liabilities plus owner's equity plus revenue minus expense, or to make the debit credit rules work, I can say that assets plus expenses equal liabilities plus common stock plus retained earnings plus revenue. So let's get some practice on this. All right, here we have some accounts, and we want to know whether these accounts would ordinarily be debited or credited to increase them. Well, if we understand what type of account it is, it's super easy to do. For example, equipment is an asset, so it's increased by a debit, isn't it? Fees earned is a revenue account, so it's increased by a credit. Retained earnings is shareholders' equity, so it's increased by a credit. Wages expense is an expense, so it's increased by a debit. Patent is an asset, so it's increased by a debit. Cost of goods sold is an expense, so it's increased by a debit. Boy, I better make sure that says D. Common stock is shareholders' equity, so it's increased by a credit. Now, I know that I'm fluid in this, and you too will get fluid if you practice. So please practice, because it's important to make sure these flow easily for you, because remember, we're learning a new language, and it's the language of business. Dividends payable is a liability, so it's increased by a credit. Accumulated depreciation is an asset, but notice it's in red, and the reason it's in red is accumulated depreciation is what we call a contra asset, meaning it's contrary, meaning that it is an asset that is increased by a credit, which overall decreases the book value of the equipment. But I just want you to start learning the little nuances and exceptions. Oh, my favorite, cash. Cash is an asset and increased by a debit. Prepaid expenses, remember, is an asset and it's increased by a debit. Gain on sale of short-term investments is a revenue account, so it's increased by a credit. Rent revenue is a revenue account, increased by a credit. Supplies inventory is an asset, so it's increased by a debit. Accounts receivable is an asset, increased by a debit. Land is an asset, increased by a debit. Insurance expense is an expense, increased by a debit. Interest payable is a liability, so increased by a credit. Deferred revenue is the same thing as unearned revenue or payments received in advance. It's a liability, increased by a credit. And dividends, yes, is a shareholder's equity, but notice how it's in red, and it is increased by a debit, because it's an exception. So that's some examples of how debits and credits impact the accounts. Now let's take a look at how to make journal entries. Here's some journal entries, and they want to know which accounts should be debited and credited. And I would like for you to pause and try this on your own. That's why it's blank. When you're ready, we'll go to the next slide. And on the next slide, let's talk this through. We paid rent on a building. When you see the verb paid, you know you're crediting cash. And because you're paying rent, and usually you don't pay rent until it comes due, you're going to debit rent expense. Thus, debit 16 and credit 1. Received in advance payment from a client for services to be rendered over the next 6 months. Well, if we received an advance payment, that means we're debiting cash. And the credit, well, we haven't performed the services yet, so we can't use revenue because we haven't earned it. So we have to use a liability account called unearned revenue. So we're debiting 1 and crediting 9. Paid salaries of employees. You see that paid? Now, you don't pay salaries to employees until they've worked, so I'm going to debit salary expense because I've used or consumed them, and I'm going to credit cash. So if you can figure out what one side of the transaction is, you can usually get what the other one is. Oh, let's try the next one. Bought a 3-year policy and paid in full. Now that insurance policy is going to be good for this year and the next 2 years. So it definitely is an asset because it has future or potential value. So I'm going to debit prepaid insurance. And notice the verb paid, so it's a credit to cash, or debit for credit 1. Perform services for a client, that means I earned some revenue, receive part of the fee in cash, and the remainder to be collected in 30 days. So I got cash, debit cash, because the asset went up. I'm also going to debit accounts receivable, which means I sold something to a customer, but they haven't yet paid me. They owe me. And I'm going to credit revenue. So this is an example of what we call a compound entry, where you can have more than one debit to make debits equal credits. Purchased office equipment, paid part in cash, balance payable in 60 days. Well, I got office equipment, so I'm going to debit office equipment, an asset, but now it's going to take 2 credits. It's going to credit cash because my cash went down, but I'm also going to credit accounts payable. And it's accounts payable because I'm going to have to pay in the future. Purchased a large amount of office supplies on credit. Well, office supplies, I haven't used them yet, so they're an asset. So I'm going to debit office supplies. And did I pay for them in cash, or did I say, oh, bill me later? And I said, I'll pay later, which is an account payable. Debit 3, credit 7. And finally, the owner invested cash in the corporation and received stock. We are not doing the owner's books, we're doing the corporation's books. So the corporation received cash and gave common stock. So notice the assets increased and the shareholders' equity also increased. Hopefully you got a lot right. All right, here's some more. So try these, see if we can do them. There's some you haven't looked at yet because they're adjusting entries, but you might as well be exposed. And when you're done, forward it. All right, made an adjusting entry for the portion of insurance premium that has expired. That means the prepaid insurance has a balance in it, and that prepaid insurance, because it's an asset, has a debit balance. Well, if some of that insurance has expired during the period, we need to make an entry for it and move it from an asset account into an expense account. So we know that to increase an expense account, insurance expense, we debit it, and to decrease an asset account, we credit it. So this is the cleaning the room piece. I had all my insurance sitting in an account called prepaid insurance, and I said, some of that has been used or consumed. It really needs to be moved over into insurance expense. And so that adjusting entry makes that happen. Paid off the office supplies purchased earlier. Those office supplies, if you go back and look at that entry, were purchased with credit on account. So this is just saying instead, pay the bill. And when you pay the bill, you debit accounts payable and you credit cash, because we're paying off the office supply bill. We're not reducing the office supplies. We're reducing our promises for our credit cards. Make an adjusting entry for depreciation. So when we recognize depreciation, that means we've used some of that equipment or machinery or whatever it is. And so we're going to be debiting depreciation expense, because remember, expenses show we've used it or consumed it, and we're going to credit the asset account that shows the depreciation, and that's accumulated depreciation. And you're again saying to yourself, I'm never going to remember this, but you are. Because whenever you make an entry for depreciation, notice you're debiting DE, depreciation expense, and you're crediting AD, accumulated depreciation. So when you depreciate something, basically you're making it dead, so DE, AD. Make an adjusting entry for office supplies used during the period. That means, remember those office supplies we purchased that are sitting there in an asset saying, I have future or potential value. Well, you don't make a journal entry every time you go to the supply cabinet, you just use the supplies. So at the end of the period, we see what's left in the supply cabinet, and we adjust the asset account, office supplies, for what's not there anymore. And so we're going to, and if it's not there, it must be an office supplies expense, which is what we've used or consumed. So we're going to debit office supplies expense, which increases the expense, and we're going to decrease the asset, office supplies, because it was used. And finally, make an adjusting entry to recognize the portion of fees received in advance have been earned. So remember that entry where we took the customer's money before we had done anything? Well, at the end of the period, if we have now provided the service to the customer, we've earned that right. And so it moves from a liability account, unearned revenue. So we're going to debit, unearned, where is it? Unearned fees. Because remember, debits decrease liabilities, and we're going to increase revenue, fees earned, because we've earned it. So notice all these adjusting entries are all done the last day of the period, and we're going to see a lot more of them, but just see, you can see the logic. All right. What this is, and this is a separate handout in your module, is everything on one page about debit credit rules, all the assets, liabilities, owner's equity, revenue, and expense accounts that you know and love, definitions of all of the accounting equation and its parts, and also the T account rules, so you can remember what to increase and what decreases. So sometimes this helps to put the little arrows at the top, because it helps you remember. All right. So today we looked at the accounting cycle and the steps of the accounting cycle, and the rest of this module is all about the accounting cycle and learning its steps and how to do them. So until next time, happy accounting!